Welcome to week 16 of the Genus Capital Management in Focus video. Today we're addressing COVID-19 once again. For those of you who don't know me, I'm Ian Lesher. I'm a partner and portfolio manager at Genus Capital Management, and I'm here with Wayne Wichel, the Chief Executive Officer and Chief Investment Officer of Genus Capital Management. So today we're just going to address all the concerns that the clients have right now that we're hearing as portfolio managers. So I'm going to get right into it. This Sunday, I read an article that ran the gauntlet of 7 issues that were going to cause angst in the equity markets, and really none of them came to fruition. In fact, the jobs report, which is one of the ones that was mentioned in the US, actually became a catalyst for the market to continue to doing well last week. So my question to you, we get this from clients all the time, is with all the negative media and the media spin and what we read, how does Genus, what tools do we have? And how does Genus kind of stay above the noise and focus on the data and focus on things that make portfolio work?
Well, the first thing we do is turn off cable news, close the door, and look at the data and what's going on with the data. And that's what drives us. We have models that look at momentum of liquidity, money supply growth, momentum of interest rates, what's happening with corporate spreads. We look at different risk indicators, and those have all turned positive. One of the main reasons the Fed has been leaning into this market, buying bonds, driving down rates, and actually even buying corporate spreads. So we look at the data, and that has to confirm our view.
Right, and you mentioned the Fed a couple times, so I might as well bring up our friend J.Powell, who he spoke last week. He had a testimony last week, and he seems to be getting much better at his messaging. The market seems to be responding to his message much better. So what really has J.Powell and the Fed meant to the market right now?
Well, they really learned from 2008 experience, and they came in and wanted to get ahead of the curve, and they did. And they dropped rates down to 0. They gave guidance, we're going to hold them down there for 2 years. And they came in and bought corporate bonds, even bought corporate ETFs. They came in very aggressively. And he's also done a fantastic job of just job boning the situation, even the market higher and the risks lower. He's saying things like, we're not even thinking of raising rates. So he's done a real good job, a real turnaround from a couple of years ago when he caused a correction effectively. And he's getting high marks all the way around. One of my mentors, a guy called Leon Tui, says that he's better than Santa Claus. He's real and he lives amongst us. So he's getting quite high accolades at this point in time.
Yeah, I think J.Powell is kind of turning into the dessert of the month club. It's the gift that keeps on giving. We hear a lot of J.Powell, we hear a lot of the Fed, but our clients don't hear a lot of what's happening in Canada. Is Canada doing the same type of buying on the fixed income market? Are they doing enough to support the markets? Is the overall economy doing as well as the US?
Well, number one, in terms of the economy, if you look at our economy is more tied to oil, for example, and commodities, has less exposure to technology and healthcare. So we don't have as many of the winning sectors, number one, in Canada. That's going to hurt our economy relative to the U.S., I would say. And U.S. probably has been a bit more aggressive in terms of focusing on the business side of things than Canada. Canada's done a better job in terms of dealing with the virus. But it's a different economy, and I think we'll have to do more things to improve the economy here. So there's issues we have to deal with here. We have a different economy based on world commodities, and it's going to hurt us more than the U.S.
Right. The consumer confidence numbers in the States have been quite good, but we're not seeing the same thing in Canada. So I think a little bit of it is messaging, and a little bit is just the oil scare and all the things that are going on here that are a little bit different than what's in the US.
That's right.
So back to COVID, we're reading every day about case spikes. Kind of all over the South in areas that we weren't seeing before. But should clients really be focusing on case counts only?
No, it's one thing. I think the media focuses on that every morning I wake up and it's new record high. I always go to the coronavirus website and look at the bottom line in the U.S. and the number of deaths have been between 500 and 600 for the past week. They're dead flat. So in spite of the rising cases, we're getting less deaths. So the issue here is it's a younger set that are being infected, and the therapeutics are so much better than they were 4 or 5 months ago. And so they have things that really knock down some of the immune issues. And so they've learned so much. They're dealing with it better. We can manage this, and so I think we're going to continue to see selective rolling shutdowns here and there across the country, but we're not going to have a total shutdown again, I would say. And we're also, the stock market, it really is a call on potential vaccine. And that will probably happen at some point in time here. And so there still is good value in the market and a lot of the beat up sectors. So those areas will do very well. These beat up value stocks we've been talking about will do very well once a vaccine hits.
Right. Yeah, I think what people may not understand is in the States, they kind of have a different testing philosophy than we do here. They're kind of testing everywhere and anyone in the US, and we're still being a little bit more selective. So that might be a reason why the case counts are so different. So you mentioned a little bit about the vaccines and the therapeutics that are coming on board. So we're kind of in a tricky phase in the market where we're going to have scares about COVID. COVID's not going anywhere. But there's a finite amount of time between now and them getting a therapeutic that really works, because we know a lot more about the virus and a vaccine. So how do we gauge that as an investor? How do we wade in that territory of uncertainty?
Well, right now, we've started, at the beginning of the year, we moved to the winners of COVID, the technology and the healthcare. And through the past couple of months, we've been moving to a barbell portfolio. We have those winners, and we also have some of the other areas that have been hurt, like financials and industrials. We're equal weighting those at this point in time here, because one day there will be an immune therapy, and so we're trying to balance this off. And if you look at the overall market now, for example, technology is at new highs, healthcare is at previous highs, financials are still down about 25%. Industrials are still down 20%. The real losers, the airlines, cruise ships, they're down still 50, 60%. So there's still value in this market. So when you hear people talking about the overall market, they shouldn't. There's a space that has really won. The digital economy has been accelerated by at least 2 to 3 years. Big winners there. But there's other areas that are still beat up. And so if there is some kind of therapy or a vaccination that really lowers mortality rates, these areas can go higher.
Right. Yeah. So basically what you're saying is there's still opportunity. It's just a matter of being in the right areas at the right time and kind of following the data.
And we're diversified between those two areas at this point in time. We haven't dipped down into the real losers in terms of airlines and cruise ships, for example, but we're in the financials and industrials there.
Right. Well, that's a wrap for today's video. Thank you very much. Thanks everyone for watching, and have a safe and healthy weekend.